If a co-founder walks away with 30% of your company before the seed stage, getting actual venture capital is incredibly difficult. The second thing is that, yes, AI is a big deal, but no, it's not the whole market. It's probably 30, maybe 35% of the early stage on Carta, which means that actually it's not even the majority of companies on Carta raising are AI companies. For sure. If you're a pre-seed company and you don't have an explanation as to how you're going to use AI, you should redo your deck. A thing is maybe not the right term for it, but like the ecosystem, the space within early stage startups, it's gotten very professionalized. Like startups feel, and when I talk to founders, they definitely feel this way, as though they need to hit a bunch of checkpoints. I'm going to raise my pre-seed, and then I'm going to raise my seed, and it's going to look like this, and I'm going to have this many people on the team and all this stuff. When the reality is, of course, that stuff happens all the time, and it's weird, and it's messy, and it takes forever, or it happens really fast. Like it's almost as though founders are now going into the venture capital journey with this roadmap and like not realizing that the vast majority of the time the success doesn't follow that roadmap, and it's just going to be a lot more eerie or weird than they expect.
Welcome to the Product Market Fit Show, brought to you by Mistral, a seed stage firm based in Canada. I'm Pablo. I'm a founder turned VC. My goal is to help early stage founders like you find product market fit. Well, Peter, welcome back, man.
Pablo, thanks for having me. Appreciate it.
Dude, it's great to have you here. I always looking through the posts you make on LinkedIn. By the way, congratulations on hitting 100K. That's a big big milestone.
Thanks, dude. Yeah, I appreciate it.
Well, listen, looking forward to kind of diving into the data. I mean, obviously, we always get questions around what's normal these days, what's going on in the markets, like where are things going, what are the trends, and again, I mean, you and Carta have, I think, the best data. I mentioned it last time because we did a Q2, and I think we'll keep doing this hopefully every quarter. But you get really granular, detailed data down to the cap table from each company, and then build bottoms up from there. So I think you have the best lens into, because private markets are like that. Like, depends on who you ask, and so I think
it's very opaque.
You guys have at scale and granular data, which is hard to get. So maybe let's start there. I mean, you just put out the report this week. What are kind of some of the big top highlights that you're seeing this quarter? And especially focused, like always, on the early stage, right? Pre-seed, seed, Series A, more than anything.
I think as you look over Q3, it was a pretty good quarter, all things considered. I think that one of the things that throws people off in this, and maybe we spoke about this last time, but I think it's probably worth reiterating. It's pretty natural as human beings to compare whatever we're doing right now to whatever the most recent peak or big moment was. And that's just not that useful for founders that are trying to fundraise. Like 2021 is not coming back. We're not going to go back to that. It was the aberration. What's happening right now is actually pretty normal. Like we see about last quarter, there was about $20 billion raised by Carta companies in price round funding. It's a little lower than Q2, but it's higher than Q1, just kind of right at that $20 to $22 billion a quarter mark. And that, if you look historically, in the beginning of 2020, it was pretty much, it's a little bit higher than the beginning of 2020. So if you just remove all the craziness that happened in 2021, like this is normal. I'd expect as we look, maybe do a little projection ahead to 2025, like things are probably going to get a little bit better, and especially with interest rates or, who knows how this election is going to play into this, et cetera. But my instinct is that fundraising is going to get very slightly easier, but not by much. And that any founders who are kind of holding back because they want some sort of macroeconomic change, they should stop doing that, because it's just not going to be that way. I think this is pretty much the water that we're swimming in for right now.
Well, it's a funny point that you mentioned that. By the way, you had a great graphic on this. I mean, we've spoken about this before, and I've spoken about it quite a bit. Like, those are the outlier years, and regardless of what almost industry you look at, you see this kind of trend line, this huge bump, this huge fall, and then back on that trend line, right? So that was like the outlier years, and I think in startup funding is the same thing. But interesting you mentioned that, because what I hear a lot, and frankly, even like what we sometimes say a lot, we're guilty as we fundraise too as VCs, is like, it's a tough market, it's a tough market. And it's like, sometimes I'm like, is it though? Like, maybe right. It's just, this is the market. That was an easy market.
It's definitely not an easy market, but it also, and this is tough for founders maybe to consider, is like the quality of the people they're competing with has gotten much higher. I mean, you would know this probably better than I would even, but there are companies being built today and founders that are going really, really hard right now that are just kind of setting the bar at really high standards. And what used to get you a Series A no longer gets you a Series A. And it's, so like the expectations have shifted, the competition has increased. There are more people, there's a lot of people who are starting to found companies or think about founding companies. And a lot of those people are very talented and they're going to move really quickly. So all of that makes it feel as though it's never been harder to fundraise. Whereas I think this is actually mostly, if you had asked a founder in say 2016, this is what they would have felt as well.
Yeah, I think so. I mean, my point was just like, it's not so much now it's easy, but like it was easy in 21, 22. Now it feels hard relatively. It's actually, this was, we're kind of back to normal. Like fundraising was never supposed to be that easy. We're never supposed to get, I had a podcast not that long ago with a founder who raised that first round right in peak hype. And like, he was super upfront about it. I'm like, how did you raise 5 million out of the gate? Not like a super founder yet, just like a very solid engineer. I think it was at Google that he worked. And he was like, it was just the times, man. Like it just, it just happened.
It just happened.
Things like that, right? It's just, that's not normal.
Yeah, that it just happened rounds are just no longer, they're no longer happening. That's for sure. What is some of the other stuff that really jumped out from this past quarter? One of the things that I'm super interested in tracking is we're kind of 2 to 3 years into the extreme boom in safes. And so safes pretty much crossed 75% of early stage funding, if we're talking about like pre-seed and seed, effectively in early 2022. So we're like 2 years on from that. Like, I'm very interested in companies that have raised their pre-seed and their seed on safes, the percentage of them that are going to end up raising Series A's versus the percentage of them that are not, and whether or not that's fundamentally different from if you raise price equity before and go to priced equity. On the whole, like if you think about it just as a hypothetical, it shouldn't matter, but I think it probably will matter. And that founders,
Why do you think that?
well, two reasons. One, because I think that people are treating valuation caps as though they're valuations and you kind of have to exceed them in order to be doing well. And that isn't historically true. Something like 30% of the time you don't exceed it and you raise on a valuation that's less than the valuation cap of your most recent safe.
Is that right? 30%?
30%. Yeah.
Wow. Okay. So that's like akin to like, I mean, it's not a down round at
It's
all.
not a, but it's not a down
It's
round.
kind of the same feeling.
But people like treat it as though it is a down round. And I think that, so they do kind of weird things to avoid that. And I think that's actually throwing people off. The val cap is just, not that early stage valuations are much more than a guess, but the valuation cap is really just like a placeholder so that you can come to some other agreements about ownership. It's not a real valuation on this company. And it doesn't include any, or most of the time, it doesn't include much due diligence at all. I think there's maybe a reckoning is too strong, but I'm very interested to see how those companies graduate into, traditional priced equity on the pre-seed side. And then the last point that I'll make is 2025, everyone that we talk to is trying to figure out how do we get some liquidity in the market. And we're starting to see that pop back up. We saw the most acquired companies off of Carta in Q3, the most since Q1 of 2022, I think. So 170 companies acquired last quarter. My instinct is that that will continue to go up. I don't have great data on whether or not those are fire sales and nobody makes any money.
That's what I was going to ask. Yeah, are they successful or not so much?
My instinct is that a lot of them are, about half of that 170 is seed or pre-seed. So at that point, you're basically just hiring the team mostly. There are probably some better acquisitions that are coming, but everything that we're hearing and when we look into M&A or secondary trends or whatever is like people are just starved for liquidity, obviously. So when will IPOs come back? Who knows? But I think the non-IPO routes to liquidity are going to be much more in vogue next year.
Yeah, part of me does wonder, like, just how much of this, these exits are kind of not positive, kind of like more something you do because you have to than something you do because you want to. And part of that is just companies finding themselves. Like, I think that we talked about this last time, but like, I think that there's just such a big lag between when things got hard and when that difficulty led to an outcome, whether it's like a down round in some cases or an exit in others. I think that startups are pretty malleable in general, and there's always so many things you can do to stretch runway if you're really like willing to go through the pain. And I think, a lot of founders are that type of person, like they're willing to go through that pain. And I mean, that's just like taking a few pieces of data that I get, anecdotally, but I feel like a lot of startups that kind of just held on for dear life are only now starting to be out of options. And maybe one of those options is winding down. Maybe one of those options is an exit, but not necessarily like a gray one.
I agree. I think the time lag thing throws a lot of people off because they think, oh, it's been 2 or 3 years. Like, of course, all these companies have to like have either succeeded or failed by now. And that's just not true. Founders do all sorts of things in order to make their businesses work. And they're willing to take on a lot of pain. They're willing to change radically their original business plan. So a lot of those companies are still kicking. Maybe they haven't really found that next new wonderful thing, but they're certainly still alive. And that's causing a lot of these metrics to look sort of strange, for sure. I think that's well said.
Well, I think, what comes to mind, and because at least there's actual data on this, like if you think about public markets, and you think about something like Bird or something like Sonder, right? I don't know if you followed Sonder. I followed it quite closely. It went IPO through a SPAC, I guess it was probably 2 years or so ago, at a $2 billion valuation. Today it's worth sub 100 million, like anywhere between 15 million was the lowest I saw it to maybe like 50, 60 million, really at peak. So just like 99% down. But the true kind of point is they're still alive. I mean, there's still, revenues actually either flattening or still growing. They burn money, and that's why they're not worth all that much. But my point is, if that startup was private and it didn't have a stock ticker that changed every day, it would probably still be more or less at a unicorn valuation. And you just don't really know how well or how poorly it's doing because it's a public company. You can see, okay, like clearly it's priced for bankruptcy at some point. That's why it's worth 60 million. Maybe it'll turn it around, but it's in serious trouble. Bird, same thing. Like they were bankrupt for so long, and then they did that merger. I don't know if you looked into that, but my point is, like that merger being one of these potential like exits, right? Again, a company that is kind of so well known that all the stuff around it is public. It takes a long time for the bankruptcies or the winds down or the forced mergers to actually happen. And in the meantime, there's a lot of different pieces that you can pull together to keep going and see if, tomorrow is going to be kind of a more sunny day.
It's really well said. There's just this, because the private market is so opaque and you can't really know what's happening within each one of these companies in between rounds until you get like this one marker and that's all you know for the next couple of years. There's just a whole 100 things that could be happening, good, bad, or otherwise inside of these companies. We just don't really know. And a lot of them stick around a lot longer. There's also, I wonder what you think of this actually. There's some part of me that thinks that early stage startup thing is maybe not the right term for it, but like the ecosystem, the space within early stage startups, it's gotten very professionalized. Like startups feel, and when I talk to founders, they definitely feel this way, as though they need to hit a bunch of checkpoints. I'm going to raise my pre-seed, and then I'm going to raise my seed, and it's going to look like this, and I'm going to have this many people on the team and all this stuff. When the reality is, of course, that stuff happens all the time, and it's weird, and it's messy, and it takes forever, or it happens really fast. Like it's almost as though founders are now going into the venture capital journey with this roadmap and like not realizing that the vast majority of the time the success doesn't follow that roadmap, and it's just going to be a lot more eerie or weird than they expect.
Yeah, 100%. And for what it's worth, I don't quite like that as like I like the professionalization of the industry because I think it leads to more options for everybody, for both sides, right? And so I think as a founder, it's like one of the awkward things is where you're not quite Series A, but you're not quite seed. You raise this, the seed extension, and if there's more professionalization, more VCs, then there's more kind of opportunities to raise at different parts of the spectrum. That I actually like. What I don't love is the idea of checkpoints, the notion that you like go into a pre-seed thinking like, okay, and then in 12 to 18 months, like I'll be here and I'll raise this round. And it's like, this stuff. And I've seen this, and we're going on tangent here, but don't really care.
No,
but I was talking to a founder I work closely with, and we were talking about, forecasting, and this is like a couple million in ARR, so has some product market fit, but I would argue they don't yet have the levers, the engines proven out. So they've gotten traction. They clearly have product market fit. It tends to go up and to the right, but it's not like they've got formulas where they're like, hey, every time I spend this much on this channel, this much comes out. And yet they feel forced, again, because it's part of this kind of professionalization theme to say, okay, like here's my budget for next year. Like here's what my revenue is going to be at the end of next year. And I'm just like, what's the point? Like how you can't just say, take Uber or Facebook or take your biggest company that you love. They do this, so I should do it. Like they have proven out formulas in so many different parts of their business through so much time with so much data that they can go and give you estimates and beat plus minus 5% almost every time. You don't have that. And so what good does it do to go out 12 months and try to behave like a big company and you're just pulling numbers out of nowhere? It does more harm than good because you kind of start, and part of the reason I said that is because like you start not just to believe that, but to measure yourself against that. And it's like, well, we had a really good quarter, but it was below forecast, or, our quarter was not good, but we're actually above forecast. I'm like, I don't care about your forecast, right? Dude. Like, who cares?
We don't expect you to be able to predict what you're going to be in 6 months, right? It's like all about momentum and progress. I mean, this is like a structural problem in some ways with the whole idea of venture capital. Like, for instance, there's a weird sub-segment, like side topic here, which is the way that you're talking about that founder thinking, which is I need to compare myself to Facebook or other people. That's kind of how like auditors sometimes compare startups to their growth rates when they're setting 409As or things like that. Like they're using data sets that include only the absolute major successes and not actually the full data set that includes all of the failures and the weirdness that happens in early stage. I couldn't agree with you more that it messes with people's heads to feel as though there's a set path. I got to hit this path. And if I hit this path, I'm doing great. And that's all that matters. And I think that it's candidly what happened to a lot of founders as the market turned was they may have even struggled and then hit their numbers. And then a lot of people turned around and said, well, those numbers don't mean anything to me anymore.
100%.
The number now is 2x that. And they go, well, I was lied to. And it's just like, that's not the way the market works, right? It's an ever-changing environment.
100%. Yeah. When you say that a company that went bankrupt, I won't say which one it was, but they were after ARR and customer satisfaction. And they were like, our ARR was 100 million and it tripled. And our customer satisfaction was off the roof, and 6 months later we were bankrupt, right? Because like those things weren't the things anymore. It was what were your margins like? What's cash flow look like? You're too big to be growing that fast and burning this much money overnight. So you just can't adapt that quick.
There's also a part of this when we're talking about one of the dynamics at the early stage, which I think is really interesting, is there's when we look at some of the metrics around the rounds that are actually happening and like the kinds of rounds that are happening, they're really clean. And they're usually for pretty decent valuations. If you're a founder today, things like high liquidation preference on your term sheet or participating preferred stock, like stuff that favors the investor, they're really not showing up in basically any early stage deals. Like less than 3% of early stage deals on Carta have a liquidation preference over 1x, which makes sense in some ways, but it also invites the question, which is if these rounds are getting done at pretty high valuations, especially here in Silicon Valley, and they're super clean, then why are seed stage valuations as high as they are? is basically the question I've been asking myself for so long. And my instinct is that it's just because the rounds that are leading the market are as competitive right now as they've ever been. And founders actually, if you're lucky enough to be in one of those rounds, can dictate terms in some ways. Whereas at the later stages, even some of the really good rounds are happening at a 25, 30, 35% discount to where they were a couple years ago. Whereas early stage doesn't feel like, yes, fewer rounds are happening, but the competition is still really fierce.
What are actually on that? Like, what is the latest numbers on, bottom quartile, top quartile, median for a kind of pre-seed round, seed, and Series A?
For a pre-seed, which we define, there's a lot of different definitions of pre-seed. We would define it as basically from $1 million to $2 million in fundraising on a safe or a convertible note before you've raised any price rounds. If you're talking about pre-seed like that, the median right now is still pretty much right at 10 million val cap. So about $1 million raised on a 10 million cap, you're talking about 10% or so of the business being sold in a pre-seed round. That's been pretty flat. There's been a little bit of the range has increased. So the 25th percentile is lower and the 75th percentile is higher than it's been in a while. The 75th percentile is something like nearly 20 million, whereas the low end is more like 5.
Like raising two, like 2 on 20, that's like 75th.
Yeah, like 2 on 20 or 1 on 5. Like both of those kinds of things are happening. A lot of that is just due to like who is the founder? Are they a repeat founder, et cetera, et cetera. For seed, it's a lot easier for us to judge this because it's just price. If you just look at price round seeds, those have actually gone, again, the valuations on those are still very robust. It's about 14.5 million pre-money. You add in about 3 million raised, that's 17.5, 18 million pre-money, or excuse me, post-money. That's a very healthy seed valuation. That's about as high as it's been in quite a while, not accounting for inflation. So maybe there's some inflation adjustment that needs to happen there. But those are very robust. And then Series A is, again, you're talking about a 40 to 45 million pre-money valuation on a Series A company on Carta. So that makes sense in terms of the jumps, but those are expensive.
10 million, kind of a 10 million debt.
Yeah, about 10 million raised or so. Now, the question that I often get beyond that is, okay, but what about AI? Like, what happens if you just strip out AI? The first point is like, why would you strip out AI? It's like a major part of the market. You didn't strip out it's weird to be like, take the thing that people are talking about and take it out of the full data set, which is, it's an odd thing that people are always on about. The second thing is that, yes, AI is a big deal, but no, it's not the whole market. It's probably 30, maybe 35% of the early stage on Carta, which means that actually it's not even the majority of companies on Carta raising are AI companies. They do have, some of them have AI stories. They're maybe using AI and automating parts of their business or whatever.
Well, probably almost all. I struggle to see almost any pre-seed these days, like new companies that are leveraging AI somehow.
For sure. If you're a pre-seed company and you don't have an explanation as to how you're going to use AI, you should redo your deck for sure.
Yeah,
like,
it's
people
tough.
are going to ask. Definitely. But investors, at least as far as we can tell, are being a little bit more discerning about, hey, this is a core AI infrastructure, dev tool, whatever company whose fundamental existence is predicated on AI existing first. And we're going to give them one valuation versus this is a company who's adopting AI as the latest technology and is using it in their business, and they're going to get a different valuation. And that latter company, those valuations are a little bit more towards the median. The infrastructure valuations can be still super, super high.
The other thing you've talked about recently is vesting schedules. You know, I have this conversation still quite often with founders, and you were talking about like changing lengths or something like that on vesting schedules. What was the story there?
Well, I'd love your feedback on this. So there was, I think, Sheil from Better Ventures put this out there, and he was like, hey, founding vesting schedules should be 8 years at the beginning because that accounts for how long it's going to take you, how much longer it's taking companies to go public, and all the back and forth about, how damaging it is to a business if one of the co-founders leaves. And then I put out a chart that showed like, hey, this is where you would be if you set it at 8 years. You'd be on the median basis, like between Series C and Series D by the time you were fully vested. And obviously founders didn't love that chart. I wonder what you think. Like right now, most founder vesting schedules are still 4 years. That's the most common that we see. We're seeing a little bit of a trend towards 6, but we haven't seen very many 8s. And I don't know. Founders, as you might imagine, push back on that pretty heavily. So what's your thought there?
I mean, the devil's in the details 100%, because like if I put myself in founder's shoes and I'm starting a company with one or two other people, and the only way that I can lose my unvested shares is if I voluntarily quit, then I would want something very long. Like, why not make it 6 years, 7 years, right? Why not make it in such a situation that if you quit 5 years in, you get less equity than I do because I stayed 7, knowing that most of these businesses take minimum 7, usually like 10 to 12 from start to exit, assuming it's like a material exit. The challenge is there's all these other side pieces, like what about if you die? I mean, that's another thing that's in the vesting schedule, literally. So like, what if you get hit by a bus, right? What happens to your invested shares? And there's no clean answer. You could easily say, well, it's, obviously not your fault, so you should still get it all. But then the flip side is, but then you're leaving me, holding the bag. What am I going to do with this company? But that's where it gets trickier. If it's a 3-year vesting schedule, you might say, yeah, it's true. If like 1 year in, I get hit by a bus, I keep holding all my equity, you're kind of, you can't really do anything anymore. But if it's 6 years in, should I really lose that extra year? Like I fought all the battles with you, a little bit more. And then the real one, the one that's really like a stickler would be, what if you get, if you get fired, right? Which again, you got to think through that. And do you control or do you not control that decision? Because what if you get fired because you're just like not working hard enough and you literally legitimately shouldn't be here anymore? Okay, well, do you want to put yourself in that position for 6, 7, 8 years or not? What if you don't control it and there's board control and it's not just you three that are going to decide this? Like, those are the things where it gets really tricky and why there's no clean answer. But I will say, like, as an investor, that's usually coming into rounds like at seed stage where we don't have control, where to the extent that we have a board seat, we're always like outnumbered by the common and the founders, on purpose. I always want to see vesting in there. I want to see minimum 4 years. And I really have a hard
4 years
time,
from when you invested.
like at least 4 years overall. I would love to see 4 years from when I invested, but it's usually not, like, there's usually such a big battle about this. And it's one of the things I'm willing to like give up on to some extent. Like, I want to see some vesting, but the amount, and sometimes I'm not so sure, because sometimes it is a situation where it's like, listen, I can't fire you. Like, only you can quit, because like we don't have board control. So like, not that I would ever do that, but even if you thought that I might, I can't. So why wouldn't you stretch it, right? And there's like not really a good answer, other than just like in your mind, you just emotionally feel
Well,
like
the answer is like,
something's
I
better
already
about
worked
it.
for this, right? Like it's already mine in my head, right? Like I did it. But I can understand, look, if I was a Series A investor, if we just move it down one funding stage, and I was considering an investment in the company and all three co-founders were fully vested, that would worry me in a bit. That would be something that I would definitely talk to them about. The pushback that the founders have made, which I think is totally reasonable, is like, one, probably someone along the way of those two or three founders put in capital to the business already. Two, it's their business, they're the ones that actually got it to this point, et cetera, et cetera. I think why vesting schedules are so emotional is that they function like this. At the beginning, they function like a prenup, where you're actually just protecting yourself against the loss of one of your people that you're partnering with us on this business. And as you probably know from a lot of these cap tables, like, if a co-founder walks away with 30% of your company before the seed stage, getting actual venture capital is incredibly difficult. Like, there's just, the cap table becomes a lot less investable on that basis. Once you're actually a going concern, though, then the vesting schedule becomes about like aligning investor and founder interests. And there was a long conversation about revesting and everything. Like, I don't really know if I have strong opinions there. I can kind of see it from both sides. And maybe it's the kind of thing where it should just be negotiated in every term sheet and every outcome is going to be a little different.
I mean, that's probably the right answer. I think part of the challenge is, like, even if, let's say it's Series A and let's say you've been there for 4 years and you're fully vested, the challenge is like the valuation you get at Series A isn't because your money losing $3 million ARR business is actually worth $50 million. It's because, we all believe that you're going to do 6 and then 12 the next year. We only believe that because like we believe in you as the team and the founders that are going to be able to will that into existence. So like, what's the protection for the investor that you're going to stick through and do that? And that's really the kind of give and take there. So there's definitely like logic to it, but yeah, I just don't think you can come up with a blanket answer. But it is funny how we said like this business, and this is something I always said, like, there are so many standards in the world of VC. When something is standard, you can't, like, try to not do that and think from first principles is so hard. So the 4-year vesting, like, there's no magic about 4. Why isn't it 2, 3, or 6? But like 4 is it. Like, it's 4. I don't know.
And I feel like the defaults here, the point about defaults applies to a ton of things. I mean, like, the one that is the most obvious to me is like, why do we use post money safes in the way that we use them? It's because it's what people have on the YC website. Like, literally, you can go into our data and find the moment where YC changes what the default is on their website, and it's very obvious in the numbers what people are using because they're just downloading it from YC. The same thing applies to, like, I don't, in that back and forth, there was some a YC partner who jumped into Shields' comments and was like, "Hey, we're considering changing this for YC companies, that it would be an 8-year vest at the beginning." And like, if that happens, the number of companies that would just adopt the YC standard would be quite high.
Guaranteed. Yeah, guaranteed. There's only few that can set a trend like that, and obviously YC is one of them. And
100%.
yeah, I guarantee it.
It's wild how like, and that has material impacts to so many people, but we're just kind of, as you put, it's like, well, this is the standard, so why do something different? Let's just go with that and keep building.
Anything else happened that's top of mind you find this quarter? I mean, quarter by quarter, like the reality, only so much changes. So I understand that, but
For sure. I think there's some back and forth on location and where's the best place to raise, early stage, et cetera. I think, to be honest, the big takeaway that I have from the location data is that it's easier to raise venture capital now across many different places in the US than it ever has been. Like, there are actually growing ecosystems in places that 5-10 years ago had no VC at all. So that's awesome. That's pre-seed and seed primarily. And those are places, like there's the obvious ones like Silicon Valley, New York. There's the tier two, LA, Boston, Denver, Boulder, et cetera. But then there's like a really long list of what we would call like tier three or up and coming cities like Charlotte or Atlanta or like places in Florida that are not Miami, et cetera, et cetera. I think it's pretty cool, but the flip side of that is Silicon Valley is still dominant. No matter, it's becoming easier. Like, more places have their own little ecosystems, but no one's really touching the Bay for both the rapidity of rounds, the fundraising capital, and then especially as you move beyond about Series A, it becomes much more concentrated into the Bay Area, New York, and maybe a couple other places.
I go back and forth on this, like, depending on who I had the last conversation with, right? Because part of me is like, yeah, you can build a business anywhere, you can do everything anywhere, whatever. And then part of me, then you just read like the amount of dollars in the Bay Area, like the amount of talent in there, like just the concentration of everything. And it's like, no, like, who are you kidding? Just move to the Bay Area. If you can't, like, just say, it's like movies, man. Like, you want to be a creator or whatever, like, just go to LA, man. What do you like?
Right. Yeah.
Just do
Go
it, right?
wait
Like,
tables at
if you're in
Hollywood.
your 20s and you can, right? And you really are like, I just want to be a creator or I just want to be a founder, like, just go to so I don't know. I oscillate between the two like all the time.
I'm with you. Like, look, if I was starting a company, I would move to the Bay. But I do think that it's cool to watch ecosystems grow up, and like part of it is also about the investors, not just the founders. Like, a lot of capital for these tier three cities is coming from local investors. Like, there's some of it is coming from the Bay, sure, New York, but a lot of it's coming from local places, which has a different sort of feel and vibe than always just reaching out to Andreessen and other people. So I think that's good overall for startups. I also think, I mean, more this year than any year that I've been focused on startups, there's just a ton of founders who are not as enamored with venture capital overall as a pathway. They're just like, yeah, maybe down the road if I need it, but pretty much I'd like to bootstrap and I'll see where it takes me, but at least I get to control my own destiny.
Yeah, I think that's something that I've seen a lot. And I think if you're doing that, or if you're doing like this one and done that we're talking a lot about, just like raise a pre-seed or raise a seed and then just don't raise anything else,
Have
then
you seen a
where
bunch
you are
of founders
matters.
like explicitly say, I'm one and done? That's my game plan.
I don't know about explicitly say, but almost maybe like after the fact, like realize that, wait a second, actually maybe I won't raise another round, like, these sort of things, or just readjusting, maybe less. What I've seen is the opposite, is that, in other words, like, it used to be, I think, more common to just say, okay, and here's what I need for a Series A, which always maybe a strong word, but like I've hated for a long time, because it's like, why is that the goal? Like, why does that need to be the goal? Like, raising a Series A is going to solve all your problems, just another thing, And so I've seen that less. And so it becomes much more about, okay, like, how do I find product market fit? Like, how do I scale efficiently, whatever those things are? And the fallout of that might be like, oh, I don't need another route, or I won't need it for a while, or maybe that's not like the number one thing that's stopping me from being successful. But just, for on a serious note, like to my last comment, I mean, I really do think you can build a business anywhere. Obviously, we've seen that time and time again. I think for specific things, like if you want a consumer startup and go big or go home, like, then the Bay Area continues to be the place. Like, if you're going to need crazy amounts of capital, the Bay Area continues to be the place. But there's so many different models these days, and that's 100% positive to your point.
Yeah, it's a really good thing. And I'm interested in the founders who, I was just talking to Bryce Roberts at Indie VC about this, of like the one and done model, or the will be the last money you ever take. And I think a lot of founders are the interesting part is, as you mentioned, when you kind of come to that realization after you've taken some capital, because I'm not sure whether or not you as the investor care. It seems like you would care pretty deeply if a founder comes to you and says, hey, look, we're never planning on fundraising again. Well, that mark is just going to remain where it is. And then at some point in the future, maybe you get paid out with an acquisition, but it doesn't really, if you have to communicate to your LPs on a quarterly or annual basis, I don't know how that makes you feel as an investor.
It's definitely, I mean, it's yet another hurdle, but like we've also seen the flip side of that, which is you get these markups and they don't necessarily like mean or lead to anything. And so like I'm pretty, and we're at C, like we're in an advantageous place in the sense that we still have, relatively, sub $100 million funds. Like we don't need, unicorn or bust. Like we just don't need that. And if we own 10% of a business, 20% of a business that exits for $200 million, like we're doing really, really well. And so from that vantage point, like it's not the challenge I would have is like to the extent that somebody feels like it's just not that aggressive, right? Like they don't really, that they're okay with it becoming a $3 or $5 million top line business and growing 20%, and that's fine. Then we're just never going to be aligned. And sometimes that's the subtle message that can get communicated if you're talking about this like one and done model. But like once the money's in, I definitely don't care about you trying to get me, that next markup. Like I really don't. And I've said it to many companies I work with that have asked me that don't have the numbers, don't have more than the numbers, like the levers to deploy that capital. And they said to me, like, do you think I can raise, a Series A with these numbers? And I'm like, you probably can't, but even if you could, just based on the numbers and the data, you're like off market. But even if you could, like, don't do it. Like, why would you do that, right? Why would you put yourself in such a deep pref stack, us in a worse pref stack? It doesn't make your odds of success that much better. So in that case, like, I'd rather you at that point, like, it's kind of this third, right? Like the third that fail, they fail. The third that crush. But that third in the middle, I'd rather you stay lean and do this kind of one and done model and make something out of it for all of us than try to just go down blindly down the path.
All right. Well, this is completely off topic, but like, I'm sure that over the last year or two, you've had to have a lot of conversations with people about that third path, like where they are. They're not failing, but they're not crushing. And they're kind of like, do I keep, how do you know that an entrepreneur is going to like keep going on that path? Or when do you have that conversation about like, hey, you're an amazing person, you maybe should try another thing. Like this is kind of a dead end.
Well, I think that dead end conversation is usually on the third that are like failing, like truly like not there's nothing there. There's like little to maybe no revenue. It's kind of, that's when it's really tricky, right? Like when you had this idea of like things are going to work out this way, do especially pre-seed, right? Really early, no revenue. And you try it and you try it and you just don't get like any traction. There is no revenue there. There's no IP because there's no value delivered. So nothing really matters. And then it's more about like, hey, do you want to just keep trying like multiple times at different things? Or do you want to return the capital that's left, maybe, take a year's worth of severance and go do something else, which is like always a tough conversation to broach, but I think something that needs to be like discussed openly because it's part of the game. Like it genuinely is part of the game. The middle third have a bit more options because hopefully they have $500,000, $1 million, $2 million in ARR. And the problem is just that instead of growing 100%, it's growing like 50% or less.
Right. Yep.
And so then it's like, okay, you're not really like Series A level, but less important than that, like the path to 100 million seems really unlikely if you're adding sub $1 million a year in revenue at that early stage. Like something is not clicking. So I think the question there is, or my advice is always like, first of all, stay lean, which is almost why raising more money is actually detriment because it's going to make you do the opposite of that. So stay lean so that you have more options. Try maybe take like, it depends on the energy level. Like if you have the energy level and you want to keep taking some shots at, okay, we're going to try this channel, we're going to try that messaging, we're going to try this thing, keep doing it as long as you're kind of staying lean. And other than that, try to become profitable and then try to exit for, 2 to 5 to 7x top line, depending on how strategic or not that it is. And we'll all not get a zero. Like what
Right.
else can you do? Right. Versus like, because I've seen the opposite, especially in that 21, 22 timeframe where those companies were able to raise because it was too easy. And now they're doing, 5 million ARR with like 50, 60, 70 people, not growing at all. It's like, there's just nowhere to go.
Do you ever have it with a founder gets to that point, makes the necessary changes, gets to, profitability or very close to it, and then looks up and is like, well, I don't want to sell. I want to try to I kind of just want to run this business for a long time.
Yeah, I mean, I guess it could definitely, it could happen. Like I think it could happen. I think honestly, most founders and like at least there's a hope there's a high integrity component. So like to the extent that that's what you want to do, and I have actually spoken not portfolio companies of ours, but companies that are not our portfolio companies that have done that, and then they've grown to like 10 plus million, but kind of like, hey, I just want to do this profitably. I mean, then you got options, right? Like find ways to kind of do a secondary, bring somebody else in who's willing to ride that different battle with you. So I think there's options there. I think that the frustrating part is the companies where they had some growth, but then it stalled. But because of the amount of money they raised and spent, there's just nowhere to go. And it's like you look at the business on a spreadsheet and you're like, this is an okay business. Like it's a fine business. It has some value, and none of it will be able to be realized because it was poorly capitalized and the money was poorly spent.
Oh, it's tough, man.
Crazy, man. It's a hard game, dude. Sometimes
all these different
man,
changes.
just buy houses, dude. Just buy houses and buy real estate. It's easy.
Just buy houses. There we go. That's easy. Yeah, I love it.
Cool, man. Well, Peter, it's been great having you on the show again, dude.
Absolutely, man. Love to be back. Appreciate it.
If you listen to this episode and the show and you like it, I have a huge favor to ask for you. Well, it's actually a really small favor, but it has huge impact. But whichever app you're listening to this episode on, take it out, go to Product Market Fit Show, and leave a review, please. It's going to help. It's not just going to help me, to be clear. It's going to help other founders discover this show, because the algorithms, whether it's Spotify, whether it's Apple, whether it's any other podcast player, one of the big things they look at is frequency of reviews. It's quantity of reviews. And the reality is, if all of you listening right now left reviews, we would have thousands of reviews. So please take literally a minute, even if you're just writing like great podcast or I love this podcast, whatever it is, just write a few words. Obviously, the longer the better, the more detailed the better, but write anything, leave 5 stars, and you will be helping me, but most importantly, many other founders just like you discover the show. Thank you.